Yes, welcome to the container panel. I'm Clemens Toepfer from Toepfer Transport. We are S&P brokers in Hamburg. We are active specifically on container ships, multi-purpose heavy lift and short sea. And if you think I look like the guy from Borealis in London, he's my twin brother and he's not here, so I'm the only twin here. So you be safe, you don't mix us up. On container shipping, the new context index had a point of 3,578 points in March, and we've dropped now 65% from them just on the index. Much more significant is the drop in the secure cash flow. In March of this year, you could fix a relatively old and not sexy 1,700 TEU. You could fix for 3 years at $40,000 a day, generating $43.8 million in cash flow. Now you can fix a similar non-eco 1,700 TEU. If you're lucky, you fix it for 6 months at $21,000 a day. Owners are willing to fix even shorter, but if you just say 6 months, $21,000 a day, you have a cash flow of $3.78 million, which is an 85% reduction in 6 months. So the market is certainly, I don't want to call it crashing, but it's certainly changing directions dramatically the last few months, and particularly since July. The companies in general have a strong balance sheet, so differently to the other crises we had before, where particularly the Germans can talk about it. Now we have strong balance sheets, and in most cases the fleets are secured on long-term charters, and so the books are based and safe for years to come. So the cash flow, secured cash flow, is huge. While sitting high and dry with this secured cash flow, the market is correcting, and there's some certain instability there and maybe some surprises. Let me introduce you to the panel. When I start with, from my far right, with Constantin Baack, CEO of MPC Container Ships. MPC owns 74 container ships of 1,000 to 4,200 TEU, and MPC Container Ships only started in 2017 and was listed on the Oslo Stock Exchange in 2018. Then we have Ian Webber, CEO of Global Ship Lease. Global Ship Lease owns 65 container ships, ranging from 1,000 to 11,000 TEU. 30 ships of that fleet is wide beam, so quite a lot of post-Panamaxes. And GSL is listed on the New York Stock Exchange since August 2008, so quite some timing there on August 2008 listing. Then we have Anastasios Aslidis, CFO and Treasurer of Euroseas and Eurodry. Euroseas own 18 container ships in the size of 1,000 to 6,500 TEU. Euroseas is listed on the NASDAQ since 2005. Eurodry is the bike side of the business, which was spun off in 2018 and has 11 bike carriers in the Supramax and Kamsarmax space. And then we have Dimitris Dalakouras, CEO of Conbulk. Conbulk is a privately owned container or ship management company who's managing ships for various investors from across the globe. Conbulk does take equity positions in their ships they manage. Currently, Conbulk manages 40 ships of 1,000 to 4,200 TEU. So basically everybody is mainly in the feeder segment, to GSL going up to the 11,000 TEUs, but majority of the fleet is in the feeder segment. And if I may start asking Dimitri, first question. Dimitri is not listed, so maybe he can be more honest. And Dimitri, I was thinking recently, we were in Singapore on a cocktail party watching down on the F1 course. And someone said to me, F1 is actually quite fascinating. They go on high speeds around the course, but after a while it gets boring, and all you hope is that maybe someone is crashing. So container has gone on quite high speeds, and are we crashing now? What do we expect? How do you see it?
Well, first of all, it's going on high speed for a very short period, so we didn't have much time to get bored. But anyway, the market has decreased substantially. There is considerably pessimism out there. The fuel demand because of COVID and congestion is definitely easing out. Ukraine has created a huge uncertainty environment in Europe and an energy crisis. China's zero COVID policy seems to be there and will remain for at least 6 to 9 months. All this is negative and definitely doesn't help the container market. On the other hand, we have a very resilient US economy for the moment. I think the economy will not crash, but there is a prevailing uncertainty in every segment in the planet. There is economic uncertainty, there is geopolitical uncertainty, there is social uncertainty, there is weather uncertainty. All this will create a persistent volatility that we have to get used to. Volatility means that things will go down, but also up in a very short time span. So the way we see this market going forward is that we will have basically everybody having a very short-term approach on the charter commitments and on their investments. And this is something that we all have to get used to. Even though the market has gone down substantially, it is still at a very healthy level. Still looking downwards, of course, but I think once the market plateaus to a certain level, we will all feel much more comfortable in the new reality.
Thank you. Tasos, how does Euroseas sees the market at the moment?
It's not unexpected that the market has dropped. I think the party at those levels, it was certain that it would come to some sort of adjustment. When the market drops faster than the time it takes to go up. So we had a precipitous drop, almost 70%, I guess, based on the indexes that you are quoting. I think we have planned our charter book and our strategy around that expected drop. I share all the comments that Dimitris said about uncertainty and volatility in the market. I think we have a very interesting supply side. We can talk about it, I guess, later in our discussion here. Things could go either way in all respects. So it's a very challenging environment, and we're starting from a position of strength, having secured, I think all of us, a certain amount of contracts that will carry us for the next couple of years.
Ian. Echoing what the previous two speakers have said, the froth has come off the top of the market. Clemens is much closer to it across a broad spectrum than we are. It's a bit difficult to tell because there isn't that much activity. There aren't that many ships coming open because they've all been fixed on multi-year charters. We don't have anything coming open until next year. So we're not in the charter market today. 6 months ago, 3 months ago, we were able to fix ships forward. We've fixed ships to start in 2024 on new charters. You can't do that today because of the uncertainty. We're also affected somewhat by seasonality. But the fundamentals still look pretty good for container ships over the next 2 to 3 years, particularly for our size segments, the mid-size and the smaller collectively. The order book is pretty modest. It's 15% of standing capacity. If you factor in some level of scrapping of older ships over the next couple of years, then potentially just the numerical supply growth, net supply growth by the end of 2025 is only 5%. Factor in the effect of decarbonisation, IMO 2023, EEIX, the fleet slowing down, and you could have a static effective supply for container ships over the next 2 or 3 years. So you only need a modest continuing increase in demand, which is what's less easy to predict, for the supportive conditions that we've seen in the last couple of years in the charter market to continue.
So there we had the sales pitch in the falling market.
So again?
There we had the sales pitch in the falling market.
Well, that then presents an opportunity for growth and investment in tonnage. But we'll no doubt talk about that.
Constantin, you were challenged 6 weeks ago, roundabout, by someone else on the question of, container ships free fall almost. We're 6 weeks later now. What do you say now?
Well, free fall, the market has dropped, yes. If you call that free fall, it's also a matter of where you're coming from. So I think overall we can look at quite some decreasing freight rates and time charter rates, but we should not forget that we're still at very, very elevated levels. Will that continue? Well, I don't know. In the end, one thing is the industry, and I think my fellow panelists here have provided some perspective, and I would like to maybe add a slightly different perspective, which is one is the industry, and there I share most of what has been said. The other thing is how are the players in the industry actually positioned, and there I can just say that on the owner side everyone has good backlog. Also the liner side is way more consolidated. The top 10, top 15 lines are all net cash. So I think the overall industry, and not just the market drivers, is in a much better shape than it has ever been, and certainly better than post-2008. So I think that in addition to kind of the market observations, which I share of my fellow panelists here, is kind of in what constitution is actually, or are the market players. And I would leave it there. I'm sure there are more questions, so I don't have to repeat some of the statements my fellow colleagues here made.
Thank you. If we stay with you, Constantin, on the supply and demand side, Ian just mentioned we have a 15% order book, which is maybe on certain segments. In general, we are over 20 in some areas, of course, way much. And in general, the outlook on the container ship market is that we have a big order book. And in container shipping, we always have a cascading effect, so that the bigger ships always push down on the smaller ones. So how do you see the supply and demand? We have obviously, besides the new buildings, we had the drop in the port delays, which is another supply of tonnage. How do you look at the supply-demand picture?
Well, overall, if you look at the order book, I agree, especially the larger sizes, there is a massive order book, and that is a fact. If you then look at the smaller sizes, there's obviously also a question of different age profile, and of course, and I think that's very important when looking at the supply side, also different impact of the new regulation. By virtue of the design of the vessels that are, in general slightly older in the smaller sizes, they have larger main engines, they run at, or they were designed to run at faster speeds. So the impact of the new regulation will be more relevant for the smaller sizes. So that means there will be more impact on supply, on vessels being available, on port rotation potentially. So we have run various analyses on intra-regional trades where we believe the impact will be the biggest in terms of new regulation. So that's on the supply side, I would say, something that will compensate. Maybe it will not compensate in full for the resolving of the congestions, but it will at least need or create the need to add capacity or to change port rotation by the liner operators. So that's the supply side. And on the demand side, I think if you look forward, we have seen, and that has actually started not just with COVID, it has started with trade war already, relocation of production from China to Southeast Asia as an example. So we have seen more interconnectivity of this world, especially in Southeast Asia, leading to more ton-mile demand, and those services are usually commenced with rather smaller vessels. So I think overall, looking at the new regulation and some supply side implications, as well as on the other side, the demand development, I'm actually positive for the foreseeable future. Having said that, I'm not saying that the recession and inflation and the whole macro environment will not have an impact. It will have an impact, and it will mean we will see some more rougher waters on the demand side in the next couple of quarters. And the question is how the consumption hubs in Europe and the US will deal with it. And to that part, I don't have an answer, and whoever has an answer, I would be very curious to hear that. But that's kind of my perspective on demand and supply going forward.
Thank you. If I may jump to Dimitri. Dimitri, on your projects with your various investors, what do they use as for market forecasts? Do they just go for MSI, or how do your investors, what do they use?
Our investors are mainly US-based hedge funds or family offices or private investors, and they all have their own economic opinion. Of course, they resort to MSI and other entities that provide analysis about the market, but this is usually mostly to confirm their already developed opinion about the market. We do very little presentation, marketing on the basis of trying to create opportunities that coerce our investors towards some kind of perception about the market. At the end of the day, we look for people who have an opinion and try to find projects to accommodate this opinion. But it is very difficult to understand where the opinion comes from. So, in that sense, I think, of course, the shipping-based analysis that we all get from Clarkson's, MSI, or other reputable organizations is very useful, but history has proven that there are so many other parameters beyond shipping that really make a difference in our business that it's very difficult to resort only to that.
Okay, thank you. And if I can ask Ian, you mentioned the order book and that it's quite small. So at the same time, you have not ordered new buildings in your fleet. So I want to hear your view on new buildings versus second-hand, and with the secured cash flow you have, of where do you see the value going forward on new buildings or second-hand?
Thanks. Well, we Global Ship Lease merged, as many of you will know, with a privately held Greek-based container ship owner called Poseidon. They did engage in new buildings. They're now in our fleet, so we have half a dozen 9 eco ships, which in today's EEIX CII environment is an excellent asset. But we don't look to engage in new buildings at the moment. We think it's far better, for us at least, other people have different views, to sweat the existing assets. There is so much uncertainty about decarbonisation, about future propulsion technology, what's the fuel going to be. We have long-lived assets, 25, 30 years. We don't think it's appropriate to invest $500 million in a string of ships where you're not quite sure if they're going to be rendered obsolete in 15 years because the engine technology is banned. We think there's plenty to do in the existing ship market. So that's our position there. In terms of and we look to exploit the cash that we will be generating in growing the fleet by adding further second-hand ships when valuations are appropriate and we can secure the right returns.
Thank you. Tasos, Euroseas has ordered new buildings, so you have a slightly different view?
Slightly different. I mean, we took the position that it's a once-in-a-lifetime, so to speak, opportunity to exploit that windfall charter rates and put the basis for renewal of our fleet. Also, comparatively speaking, new buildings were a lot cheaper than investing second-hand projects, at least uncovered. So we thought that by embarking in this new building program, we ordered 9 ships. I think overall cost is around 350 million. That would put the basis of the company for the next decade. These ships are very modern. They consume more than 30% less than their peers that are currently on the water. So despite the uncertainties about propulsion and the fuel of the future, any change would have to be gradual. So these ships, being the most environmental friendly, would be the first to be chartered, and that would continue the company and in shipping and provide returns for our owners and shareholders. So that was the fundamental view of for ordering the new buildings.
Yeah, thank you. Well, you ordered the new buildings speculative, as you mentioned, so you didn't have charters, and I know the first ships were chartered very well, so yeah. At least the first ones look like a winner, and the rest...
The first two have been quite winners. I mean, we chartered them at a rate that in 3 years, the whole cost of the vessels gets repaid. We're looking forward to charter the rest, but even if we charter them at a third of the rate, even at historical average, appropriately adjusted historical average for their quality, we should be able to enjoy good average, at least average returns or better.
And Constantin, MPC ordered also new buildings, and MPC container ships at least is more careful and wants to secure charters. Now going forward, this might be fixing forward a bit more difficult in this environment now, but how do you see your strategy on new buildings or versus second-hand?
I mean, in terms of new builds, we would not order new builds without a charter. I mean, I would say that's a starter. We have done 4 new builds. All new builds are basically repaid through the initial charter. So we were able to actually line up charters hand in glove with setting up the new building contracts. So we will do that selectively going forward as well. I mean, these projects are different to new building projects pre-2008, where people have either ordered on speculation or have chartered them out, so very quickly. I mean, they need time. We want to be selective on growth and selective on new builds because it's a high market. It still is a high market, so every growth should be carefully considered versus other opportunities in terms of capital allocation. We want to maintain a very rational stance as far as that is concerned. But in general, we believe there will be more new buildings. We have, for example, done 2 new buildings on conventional propulsion, methanol ready, and 2 actually dual-fuel methanol vessels with a 15-year charter. And there we have also involved the cargo side, which is highly unusual in container shipping, that you have effectively also the charter being backed by a COA, 15-year COA. So I think that is the type of deals that I can envisage we will also do going forward. These deals take way longer, so it's not an ordering off-the-shelf standard design and match a Maersk charter against it. It will be a more kind of, let's say, collaborative approach, and therefore I think it's good that we take it step by step. But I clearly see more of these opportunities involving also, let's say, optional premiums to go green, right? It's not saying, we have not ordered and say that the green fuel will be there as of tomorrow, right? But the ambition and if you get paid for the optional premium, I think it's a very viable and valid path forward, and we would continue to do that selectively.
Thank you. Now, we have inflation and we have rising interest rates. So I would be interested, and let me start with Tasos on this. What's your expectation on inflation and the higher interest rates and the impact on the sector?
Yeah, I think a long question, a difficult question, challenging question. Clearly, expectations of higher interest rates, already here there are higher interest rates, they tend to reduce economic activity, GDP growth. That was the purpose, I guess, for instituting higher interest rates by the central banks in order to control inflation. That, in turn, lower economic activity should result in lower demand for containerized trade. I think there has been historically a link between GDP growth and containerized trade. And although the multiplier has come down over the last 20 years, still there is a link. So less growth, less trade, that should be not positive, to put it mildly, for shipping. At the same time, the inflation and the geopolitical uncertainty might create a reversion, an aversion to spending, at least in durable goods, switching to services. That's also potentially negative for containerized trade. However, all of these are based on a lot of this based on expectations. Expectations can change overnight. If people feel more comfortable about the stock market, say the least, or how their jobs continue, and in the US, I have to say, despite all of these factors, we have one of the strongest job market ever, I would say, with the unemployment rate 3.5%. That could be contributing factors to demand for goods and containerized trade. So one thing that is certain is that we're in a very challenging period with many factors being up in the air, trying to figure it out, both on the supply side that my colleagues here mentioned, but also on the demand side.
Yeah, thank you. Ian, looking at the leverage, what do you think is the right leverage in the current environment and in general looking forward?
Well, I don't think there is one. Just be prudent. I mean, we've all had the opportunity of backing the truck up in the last couple of years with elevated asset values to load more debt on our balance sheets. Most of us have resisted that temptation. We certainly have. Most of us have older assets as well, so the bankers won't let you borrow excessive amounts. We prefer to look at financial leverage in looking at that, the ratio of net debt to EBITDA, and we're pretty comfortable on that measure, and that will further improve with deleveraging through debt amortization. But we're aware that most of our bank facilities have loan-to-value covenants, so we want to build a bit of cash on the balance sheet for increased optionality and resilience, and we have some unencumbered assets. But I don't think there's a right answer to your question where you've got asset values that are doing this. So you just have to run your business cautiously and be able to respond to any downturn.
If I can add a point here, I mean, debt is good in the sense that it improves shareholder returns. Of course, the level of debt is that we're discussing. You cannot assume the historical average of debt when the market is at the peak as it has been still over the last couple of years. So we view that the traditional level of debt between 50 and 60% at historical average values, if you take that absolute dollar amount, that might be a prudent level of debt we have now to improve the shareholder returns and at the same time reduce the exposure to potential change in value. So I would guess that is between 20 and 30% at today's levels would be a debt level that could be sustained if the market drops and at the same time improve a bit your returns.
Thank you. Constantin, how does MPC manage its leverage at the moment?
Well, we have very low leverage, to be frank, and I think leverage is also a question of what type of asset do you want to finance. On our new builds, for example, we would definitely, if we have 7- and 15-year time charters, we would definitely look at slightly higher leverage. On the fleet where we have long-term cash flows locked in and second-hand fleet, we believe it's also about maintaining enough flexibility and optionality in the balance sheet because markets can move quickly. I mean, 3 months ago, values were still up, you know. You should never get trapped in a LTV or covenant trap. That is, I think, the most important thing when managing a capital-intensive business. And therefore, I think it's, I mean, I agree with a lot what Ian said, that there's not the right number, right? You need to be ready to act in every kind of market and make sure that you don't run into difficulties if the market drops and still maintain enough flexibility, also act on opportunities, but also to fight potentially a bad market. The next part is obviously any leverage should be linked to a clear, you know, reason for allocating that capital. I mean, why you want to optimize returns? Yes, that's one thing. You want to do an investment that is accretive on a per share basis, then it can make sense to increase leverage. So I think it boils down to having the right leverage at the right point in the cycle, to have flexibility and make sure you use the leverage for something that creates value going forward. And that, I think, are the two most important principles in my book.
Yeah, thank you. I think it's in general, I mean, the shipping industry is full of cash, and looking at the German banks, I think in this next downturn, they don't have to worry about shipping so much. I think there are other industries that German banks have to worry. Dimitri, on your more single projects with your investors? What leverage do investors take?
Well, in general, our investors are very averse to leverage. Most of them like to be cash investors, 100% equity. Of course, once we employ the vessels to a reputable charter for a specific time, then it is obvious that some leverage that is fine-tuned to the guaranteed or perceived income is there to be taken. But it is case by case, and the truth remains that most investors are really averse to any type of leverage. So it's not a big issue that we have to deal with.
Yeah, okay. Thank you. Tasos, if we, Amit Mehrotra, one analyst, recently suggested we should be looking less at net asset value, but more rather on sustainable cash flow attributable to equity holders. Now, obviously, most of the companies here have a lot of secured cash flow. What's your point of view on this comment from Amit Mehrotra?
I think at the point of time that we are at right now for container companies, for container assets, I think looking at the cash flows, the contracted cash flows is probably the easiest and the safest way to value your assets, simply because the market is in changing mode and sort of is coming down. I mean, NAVs are meaningless if you don't intend to capitalize on them. I mean, we had NAV $7 a share 3 months ago, but values have changed the last 3 months. So what was the value of the $70 per share? But specifically, if you look at the contracted cash flows, that's a very tangible way of pointing where the value is. So that, I think, is probably the best way to value, especially older vessels right now in the container ship market.
Yeah. Ian, do you agree?
Yes, I do. It was a very welcome report. Eventually, somebody seeing sense from the sell side. Container shipping is a bit different to the other forms of shipping. We make money by renting out the assets, and that's cash flow. Okay, dry bulk and the wet trades do the same, but they also make a lot of money by flipping assets. So NAV and asset value is much more relevant. It's less relevant with container shipping companies. We want to own our ships for as long as we possibly can and make money from them right through to the end of useful life. So we agree completely with that being a better way of looking at valuing businesses.
Yeah, of course, if the contract length is not as long as it is now, then you rely a lot about, if you go the earnings approach, you rely a lot of making assumptions about the earning capacity of the vessel. That being the case, the price of the asset is probably the best estimate of the future earning capacity, because the market makes collectively that decision, that assumption for you. So it depends on whether there are contracts or not. If there are lacking contracts, probably NAV is a good point of reference, but in our case that we have, luckily enough, contracts of certain duration and relatively elder vessels, it makes perfect sense to focus on the earnings approach.
I would actually add a slightly different perspective, because one thing is to value the assets, the other thing is to value the company. And I think in the end, valuing the company also means, and that is what the quote said, basically equity attributable and ideally going to shareholders. So I think it's not just valuing the assets and the underlying cash flows, it's also valuing the approach in allocating capital, also in terms of dividend policy at the right point of the cycle, and actually returning capital to investors. And that's why I think an NAV approach is good to value assets, but it's not necessarily the right way to value companies, because for companies, it's also a matter of returning capital to investors at some point in time. And therefore, I think it's also a combination of valuing the assets, the cash flows, and actually the flow of cash flows, not just within the company, but to investors. And that is, in my view, very important. And that's why at least we have placed a very clear emphasis on distribution at that point of the cycle, and then pay out a comparably high dividend at that point in time as we speak.
I agree, that's a fair point.
Looking at the secured cash flow and the valuations of the companies, and we see Seaspan being taken private, and we have a number of container ship companies, or most I can think of, have a very strong backing of a single shareholder. What's your view, if we start with Tasos, what's your view on maybe any moves to take any companies private in the container ship sector?
I can tell you that's a topic that has frequently been discussed internally and by advisors who propose to us ways of dealing with a severe discount to the intrinsic value of the company. I think our view continues to be that there is merit in being public, even at a smaller market cap as we are. I think that has, over the history of our company in the public market, has provided significant opportunities to make joint ventures, to collaborate, to raise money and do better financing deals at points of time. So although I see that you can take some of the assets at a discount if you take them privately, at the same time we see and we value the flexibility and the openness the public markets assign to you, give you and assign to you. And I think for this cycle, at least for the time being, we want to stay with being public.
Ian, not only to look at GSL, but what do you think also, well, for GSL, but also what do you think in the industry? Are we going to see other cases like Seaspan?
Well, who can tell? Every board has its own assessment of the opportunities, risks, and so on. I essentially agree with what Tasos has just said. We like being a public company, notwithstanding what some of the financiers said on the previous panel. We believe that it does increase the sources of potential capital. We've tapped the public markets in debt, equity, and in between over the last 3 or 4 years, moderately successfully, which has helped create the platform to allow us to double the size of the fleet in 3 or 4 years. So we're very comfortable being public. But we're a public company, so there is, on the face of it, a public valuation, which we've just talked about.
Constantin?
Nothing to add, I fear.
Good.
I agree.
Yeah. Just quickly before we finish, I'd like to hear some of your views on. We're looking at CII and EEXI for the container ship segments. I think also Constantin, you said that recently that EEXI might not be the deciding factor because EEXI reducing speeds is what container shipping has done for the last 10 years. So a lot of tonnage it's not. But on CII, if I like to ask Dimitris, on CII, do you think CII will have more of an impact, and are you already implementing things for CII because it's going to be, well, effective from January onwards counting? Well,
the CII discussion is a very long one, and I think most of us attended a Maersk seminar last week. It is fairly obvious that there are a lot of question marks about the implementation of CII, especially since liner companies control a big chunk of vessels, and they have also a capability of reshuffling their routes and their trading patterns of specific ships, so they can somehow tamper the results that way. The things that an owner can do on an older vessel regarding CII are very limited, and of course we will do whatever can be done. But at the end of the day, CII is more related to the trading pattern of the vessels, so this is completely out of our control. I think that at some point there will be a clause, hopefully a BIMCO clause, that will govern most charter parties in this regard, and everybody will have to abide to. The owners will have to abide by doing whatever retrofit is possible and feasible for each vessel, and the liner companies will have to support this by changing the rotation of the vessels according to each vessel's characteristics. So I think it will be, in order to go through this CII discussion smoothly, it has to be some kind of cooperation between owners and charters going forward. And I think this is what will happen in everybody's favor.
Yeah. Yeah, thank you very much. I also recently talking to a Baack owner, I said it's going to be interesting from their perspective. They say once we follow ships and we know a ship is in a bad rating, and we know the ship needs for that year some long voyage, you know, we're going to be paying different charter rates for that ship for that, you know, long voyage, etc. So it's going to be a lot of things there, and it's still quite unclear how this whole thing will go. Now, we're 40 seconds over. Don't want to hold you from lunch. Thank you very much for my panelists here, and thank you very much, and enjoy lunch.
Clemens, thank you.